Hello students, welcome to Legacy IAS Academy. Today we are going to discuss about the recent widening or increase in the deficit in the current account of India that has occurred, and also we are going to discuss in detail the relationship between how the current account deficit influences the forex reserve of India as well as even the exchange rate of India's currency. So first let us start the context in which we are discussing this particular issue is because recently it has been announced by the government that India's current account deficit, also called as CAD in short, increased to almost $23 billion, that is almost 2.7% of India's GDP in the third quarter of year 2021, financial year 2021-2022. If you compare this this quarter's figure with the last two quarters, what we see that last quarter the deficit was almost $9.9 billion, 1.3% of GDP, while before that in second quarter the deficit was just $2.2 billion, that is 0.3% of GDP in the previous financial year of 2020-2021. This widening of current account deficit as per the report of Reserve Bank of India is mainly believed to be on the grounds of higher trade deficit. In other words, it is the trade deficit that is driving the current account deficit to a much more higher level. So let us try to understand all this financial jargon in a simplistic way. So first let us try to understand what is the current account deficit. So we know that every day we have people or citizens of India that are engaged in a trading arrangement with other countries all across the world. That means this trading can occur in two ways. One way is that it is the Indian citizens, Indian companies that are buying something, or in other words importing something from foreign countries. At the same time, a lot of other Indian companies and citizens are exporting some goods and services to the other foreign countries. That means we have two components of the trade here. First is exports plus investment that is also coming to India. All these will be the money that is coming to India, the reserves, the currency that is coming to India. And also on the other hand, we have imports as well as the FDI, FIIs and FPIs. That means the Indian citizens are exporting some goods and services and also doing some foreign investment. For example, as simple as buying a stock of Tesla or buying one stock of Apple. And at the same time, we have imports coming from the foreign countries as well as the investment, foreign investors buying Indian stocks as well as investing in the Indian companies. So these two together is the whole trading landscape of any country. Now, if we try to understand this, what is here? So this chart that you see, this is called as balance of payment. Balance of payment is nothing but a kind of ledger or kind of account that maintains that how much money has gone away from India and how much money has flown in India. So here this balance of payment is made up of two different balances. The first is called as current account balance, while the second is called as capital account balance. So the current account balance again basically is made up of two components. One, it is called as a trading component, and other it is called as invisible components as clearly mentioned here. So in current accounts, what is the trading component? Trading component is basically all the goods exported and imported from and to India. While invisible balances are something that is not clearly visible. This can be in the movement of services. For example, a software company of India has demanded certain services from a US company or vice versa. So that is called an invisible balance. As per the balance of payment ledger of India, what we can see that India is currently running current account deficit. That means in the terms of dollar, about $26.6 billion are the worth of current account deficit. At the same time, we have the capital account balance. What is capital account balance? It is the sum total of foreign investments in India, foreign direct investment, foreign portfolio investment. Apart from that, the banking capital, short-term credit that has flown to India, the external assistance that has been given by the foreign companies as well as foreign governments to India, as well as the external commercial borrowing by the Indian companies. And in this, India currently have a surplus. That means India is running a surplus of $90.1 billion. So in short, India has a deficit in the current account of $26.6 billion, while India has surplus on its current account of almost $90 billion. So if we try to reach at the final figure, currently India has an excess of $63.5 billion in its economy. Now let us try to understand that how and what is the current account deficit. So the first thing is that why India has current account deficit. So India has current account deficit because we are importing more and more amount of goods and services as compared to whatever goods and amount of goods and services we are exporting. That means it is possible in simple terms that India is importing $100 worth of goods and services, while at the same time it is just only exporting $10 worth of goods and services. In that case, if we try to understand what will the current account of India, so it will be deficit of almost minus $90. So that is as simple as understanding the current account deficit. Now, how does these influences the exchange rate? That is a very important determinant of the strength and resilience of any economy. So what is exchange rate? Exchange rate is determined by the trading that is happening between two different economies. For simple terms, suppose that in a particular year, on a particular day, Indian citizens and companies want to buy $100 worth of goods from the US. That means to buy this $100 worth of goods from US, Indian citizen first will have to convert his rupees into the dollar. So suppose that currently the dollar exchange rate will be somewhere 70 rupees. That means you have to for buying $1 you have to spend 70 Indian rupees. But suppose next year this scenario has changed. Now more and more Indians want to import more and more goods and services from the United States. So next year, suppose instead of $100, Indian citizens and companies want to buy $1,000 worth of goods and services from the US. Now for buying $1,000 worth of goods and services, obviously India will have to spend a lot more of Indian rupees to first convert into dollars and then use this dollar to buying of goods and services. So due to this high demand of dollar or increase in the demand of dollar, what will happen? There will be a strengthening in the value of dollars. That means in the last year, while only 70 rupees was sufficient to buy $1, now you will have to sell out 80 rupees to buy same $1. So this is called as appreciation of dollar or a strengthening of dollar. At the same time, we can say that Indian rupees has weakened up or depreciated. So in this particular scenarios, suppose that year was 2020 and this was year 2021, we are seeing appreciation of dollar and depreciation of Indian rupees. Why? Simply because more and more people and citizens of India want to import from the USA. So that is how the exchange rate is determined, that how much amount of import and export is happening through any particular in any particular year through any particular economy. Now obviously in India, the Reserve Bank of India plays a very important role in maintaining this balance of payment. So how this Reserve Bank of India plays an important role in maintaining BoP? So first of all, if we try to look at same BoP, as we discussed before, India currently has minus $26.6 billion as current account deficit, while it has $90.1 billion of capital account surplus. That means in India's economy, we have a net inflow of $63.5 billion. Now this $63.5 billion that has flown into India, that has increased in the economy, will be considered as an asset to the RBI, because RBI withdraws this excess amount with itself. So $63.5 billion is added assets to the RBI. Now what about its liabilities? So any assets that is added in the RBI's account will have to be maintained by increase in its liability. And what is the liabilities of Reserve Bank of India? The major liability of Reserve Bank of India is the currency or the Indian currency note that it publishes every year. If you try to look at the Indian currency note, you see that there is a phrase that is mentioned there, that it is RBI that will have the obligation to pay the bearer the same amount of money that he or she is holding. So if assets of RBI is increasing, it will also have to increase its liability. That means it will have to print more and more money. And if it prints more and more money, in that case, it can also rise the inflation rate of the economy. So what does RBI do? Instead of letting all the assets go into the free market, it actually build up its forex reserve. And that is what you can see from the news that has come few weeks back actually, that last week RBI announced that its forex reserve has grew by almost $63.5 billion. Now you will be able to read it. Why forex reserve of RBI has grown by $63.5 billion? Because it is the surplus money, the same surplus money, $63.5 billion that has entered into the Indian market, considering both the capital account as well as the current account. Now the question comes that why RBI intervenes if we have growth or a deficit in the capital or current account. So simple reason is there. If suppose India's capital account is growing or has actually encountered a surplus as the last case, so in that case rupee, as we discussed before, obviously will start to strengthen, because more and more demand of rupee is going on as compared to dollars. So if rupee is strengthening, that means earlier $1 was 70 rupees, now $1 will be somewhere about 60 rupees. In that case, the export will become much more costlier, as well as imports will become much more cheaper. Now understand this, why it will happen. If earlier $1 was 70 rupees and now $1 is 60 rupees, that means rupee has strengthened. That means for exporting something, now the US citizens or US people or US companies will have to sell out more amount of dollars for importing same amount of goods and services from Indian economy. But at the same time, now people of India will have to spend less money to buy the same amount of dollar for their import. So as the imports become cheaper, what will happen? As exports become costlier, obviously exports will go down, and if imports become cheaper, obviously the imports from India will go up. And due to this, what we'll see? We'll see a widening of trade deficit. What is trade deficit? It is the balance of import minus exports. So due to the costly exports and cheaper imports, the trade deficit of India will widen up. And this widening of trade deficit will cause another problems. And this is the reason why RBI has to intervene, so that the excess money that is entering into the Indian economy by the capital account surplus is taken by RBI and then deposited in its forex reserve. So what is the net impact of this? The RBI's forex reserve have gone up. The rupees stability vis-a-vis dollar, or the exchange rate of rupee has remained stable, and also the inflation rate has remained stable, and trade deficit will also not widen up. So the main conclusion we can draw is that due to the intervention of RBI in the case of growth in capital account surplus, the balance in the economy is maintained, and that is the reason why RBI intervenes. So I hope you understood the relation between current account deficit, capital account, balance of payment, forex reserve, as well as the exchange rate of Indian currency. That is all for today. Thank you very much.